WeWork was not doomed because people stopped wanting nice offices. It was doomed because it tried to sell ordinary office leases as if they were a tech revolution. That was the trick. Take long-term real estate risk, wrap it in startup language, add glass walls, cold brew, a charismatic founder, and suddenly the market was supposed to believe this was not a landlord business. It was a movement. But underneath all the branding, WeWork had a very simple problem. It rented space for a long time, rented it out for a short time, and hoped the vibes would cover the gap. That is not software. That is financial mismatch with better lighting. For a while, the story worked. WeWork was not just selling desks. It was selling ambition. It was selling belonging. It was selling the fantasy that if you sat in the right room, surrounded by the right people, your little startup might become the next unicorn. And in the 2010s, when cheap money was everywhere and investors were desperate for the next big platform, that fantasy became extremely valuable. At one point, WeWork was valued at around $47 billion. A company built on office leases was valued like it had discovered a new operating system for human productivity. Now imagine a woman named Rachel. She's 29, building a small skincare brand from her laptop. She walks into a WeWork for the first time, and it feels nothing like a normal office. There's music. There are plants. There are founders in hoodies taking calls about seed rounds. The coffee feels free because it's included in the membership. She doesn't feel like she's renting a desk. She feels like she's joining the future. That feeling was the product. And that matters, because WeWork understood something real about psychology. Humans don't just buy utility, we buy identity. A gym membership is not just access to equipment, it's the hope of becoming a disciplined person. A luxury handbag is not just leather, it's a story about taste and success. A WeWork membership was not just a chair and Wi-Fi, it was a signal that you were building something. For freelancers, founders, creators, consultants, and small teams, that signal mattered. Working from your kitchen table can make you feel invisible. Working from a beautiful co-working space can make your dream feel like it has a physical address. So WeWork's appeal was not fake. The emotional insight was real. The problem was that emotional insight does not fix bad unit economics. WeWork's business model had a crack in it from the beginning. The company signed long-term leases with landlords, spent heavily to redesign the spaces, and then sold short-term memberships to customers. When the economy was strong, startups were hiring, freelancers were spending, and investors were throwing money around, the model looked exciting. Occupancy went up, new locations opened. The brand got louder. But when the economy weakened, customers could leave much faster than WeWork could escape its obligations. That was the core issue. WeWork's revenue was flexible. Its costs were not. A member could cancel. A startup could shrink. A company could decide remote work was cheaper. But WeWork still owed rent, month after month, year after year, in city after city. That kind of mismatch can be survivable if you are disciplined. But WeWork was not built around discipline. It was built around growth at almost any cost. This is where the psychology gets interesting. Investors didn't just invest in WeWork's numbers, they invested in its narrative. And narratives can be intoxicating. When a founder is charismatic enough, when the offices look cool enough, when the valuation keeps going up, people start to confuse momentum with proof. Adam Neumann did not simply pitch a co-working company, he pitched a vision of changing how people live and work. That sounds ridiculous now, but in the right market environment, big language can make a risky business feel inevitable. Investors don't want to believe they are funding a company with lease exposure. They want to believe they are early to the next Amazon, the next Airbnb, the next platform that rewires society. And that desire creates a trap. If the story is big enough, the details feel small. The leases? Details. The losses? Details. The governance concerns? Details. The fact that this tech company still depended on physical buildings, expensive renovations, and human occupancy? Somehow, also details. Until the IPO process forced everyone to read the details. In 2019, WeWork tried to go public, and the magic started to break. Suddenly, public investors were not just listening to the dream, they were reading the paperwork. They saw the losses. They saw the unusual governance structure. They saw the conflicts of interest. They saw a company that talked like a spiritual movement but burned cash like a furnace. The market looked at WeWork and said, "Wait a second, this is an office company." That was the beginning of the collapse. The IPO was pulled. Adam Neumann stepped down. The valuation crashed. SoftBank had to step in. And WeWork became one of the most famous examples of what happens when private market hype runs into public market scrutiny. But the deeper issue was not just one founder. It was the contradiction at the center of the company. WeWork was priced like a transformational technology platform while carrying the risks of a real estate business. Then came the pandemic, and the office world changed almost overnight. Remote work went from a perk to a normal part of business life. Hybrid work became the default for millions of employees. Companies started asking a dangerous question for commercial landlords. Do we actually need all this space? In theory, this could have helped WeWork. Flexible office space sounds useful in a hybrid world. Companies don't want huge long-term leases? Great, give them flexibility. Small teams need occasional office space? Great, WeWork should benefit. And that part of the idea still makes sense. Flexible work is real. Co-working is not dead. In 2026, WeWork is still trying to reinvent itself after bankruptcy. It has launched smaller office concepts like WeWork Go Pods, and it has been expanding again in parts of New York. The company that survived is leaner, more cautious, and much less magical than the version that once promised to elevate the world's consciousness. But that's exactly the point. The idea of flexible office space was never the crazy part. The crazy part was the valuation, the spending, the founder mythology, and the belief that a tough, cyclical, low-margin business could become a world-changing tech platform just by saying the word community enough times. WeWork after bankruptcy is basically an admission of what WeWork should have been all along, a flexible office operator that has to care about leases, occupancy, rent, margins, and cash flow, not a religion with conference rooms. In 2024, WeWork emerged from bankruptcy after cutting billions of dollars in debt and renegotiating or exiting many leases. That restructuring was not just a legal event, it was a reality check. The company had to shrink the fantasy down to something closer to the actual business. And this is why WeWork is such a useful story. It shows how dangerous it can be when investors, customers, and employees fall in love with a feeling. Rachel, the small business founder, wasn't wrong to love the space. Maybe WeWork helped her feel motivated. Maybe she met collaborators there. Maybe having a clean desk outside her apartment made her more productive. At the customer level, the product could be genuinely valuable. But a good customer experience does not automatically make a good business. That's one of the most important lessons in finance. A product can be beautiful, popular, and culturally relevant, and still be a bad investment if the economics don't work. Restaurants can be packed and still lose money. Streaming shows can be loved and still be unprofitable. Delivery apps can feel convenient while destroying margins. And co-working spaces can look like the future while carrying rent obligations from the past. WeWork's downfall also reveals something about status. In the startup world, physical space became part of the performance. The office wasn't just where work happened, it was a stage. Founders wanted to look funded before they were profitable. Teams wanted to feel bigger than they were. Investors wanted to see energy, not spreadsheets. WeWork gave everyone a set. And when everyone is performing growth, it becomes harder to ask boring questions. Questions like, how much does this location actually cost? How long is the lease? What happens if occupancy drops? How much cash are we burning to create this atmosphere? Are we building a durable company? Or are we subsidizing a lifestyle brand for startups? Boring questions are often the questions that save you money. There is also a lesson here about charisma. Charismatic founders can recruit talent, raise capital, inspire teams, and create markets. But charisma is not cash flow. Charisma does not pay rent. Charisma does not make a bad contract good. In fact, charisma can make risk harder to see because people don't want to disappoint the story. If everyone around you believes the founder is a genius, questioning the numbers can make you feel like the small-minded person in the room, and nobody wants to be the boring person killing the dream. But finance rewards the boring person more often than people admit. The boring person asks what happens if growth slows. The boring person asks whether revenue is recurring or temporarily inflated. The boring person asks whether customers are sticky, whether costs are fixed, and whether the downside has been seriously considered. WeWork needed more boring people. It had enough vision, it had enough branding, it had enough inspirational language printed on walls. What it needed was a colder look at the basic trade: long-term liabilities, short-term customers. Because that was the original sin. If you sign long-term leases and sell short-term flexibility, you are taking the risk your customers don't want to take. That can be a valid business. But you have to price that risk correctly, manage it carefully, and definitely not pretend it is software. The irony is that WeWork was early to a real trend. Companies do want flexibility. Workers do want alternatives to home and headquarters. Freelancers do want places to belong. The world did move toward a more flexible relationship with office space. WeWork was not doomed because the idea was worthless. It was doomed because the story became too expensive for the business underneath it. And that is a pattern you see again and again in bubbles. A real insight gets discovered. Then capital floods in. Then the story gets bigger than the numbers. Then people start defending the valuation with adjectives instead of math. Innovative, disruptive, mission-driven, category-defining, inevitable. But eventually, every business has to answer the same plain question. Does this make more money than it costs to operate? For WeWork, for a long time, the answer was no. The lesson is not never believe in ambitious companies. Ambition matters, vision matters, culture matters. But when a company asks you to value it like technology, check whether it behaves like technology. Software can scale with high margins. Real estate usually cannot. Software can add users without signing a 5-year lease in Manhattan. Real estate cannot. Software can fail fast. Long-term leases fail slowly and expensively. So when someone tells you they have reinvented an old industry, look closely. Sometimes they have. Sometimes they have just renamed the old risks. WeWork renamed renting offices as changing the world. And for a while, the world believed it. But the rent was always due. This video is for educational and entertainment purposes only and does not constitute financial or investment advice.